look-through book value would not mean much, actually. The very best businesses, the really wonderful businesses, require no book value. We want to buy businesses really that will deliver more and more cash and not need to retain cash, which is what builds up book value over time. Admittedly, the prices of marketable securities at any given time are not a great indication of their intrinsic value. They are far better, though, than the book value of those companies in indicating intrinsic value. Berkshire's intrinsic value, in a very general way, and trends in it are better reflected in book value than is the case at a very high percentage of companies. It's still it's not a great proxy. It's the best. It's a proxy that is useful in terms of direction, in terms of degree, in a general way over time, but it's not a substitute for intrinsic value. In our case, when we started with Berkshire, intrinsic value was below book value. Our company was not worth book value in early 1965. You could not have sold the assets for that price that they were carried on the books. No one could make a calculation in terms of future cash flows that would indicate that those assets were worth their carrying value. Now it is true that our businesses are worth a great deal more than book value, and that's occurred gradually over time. So obviously there are a number of years when our intrinsic value grew greater than our book value to get where we are today. Book value is not a bad starting point in the case of Berkshire. It's far from the finishing point. It's no starting point at all of any kind in whether it's the Washington Post or Coca-Cola or Gillette. It's a factor we ignore. We do look at what the company is able to earn on invested assets and what it can earn on incremental invested assets, but the book value we do not give a thought to.